Well, as we mentioned, it's been a volatile start to 2025 on an intraday basis anyway, with the S&P and NASDAQ on pace for their longest daily losing streaks since April. Here with their market outlooks, Kathy Jones, Charles Schwab Chief Fixed Income Strategist, alongside Jeremiah Buckley, Janus Henderson Equities Portfolio Manager. They join us now, and it's great to have you both. Kathy, weigh in here on maybe what your interpretation of the bond market's message has been with this surge in yields since the Fed's rate cut, actually since September, but also since the December meeting.
Yeah, Mike, I think it's a combination of factors. One is the growth expectations have ramped up because we saw growth outperform, particularly if you go back to last fall when we got those big revisions to GDP and employment data. So we had the growth picking up more than expected. We've had the shift in the Fed's outlook, and then we have all this uncertainty about policy going forward, whether fiscal policy will be stimulative on top of an economy that's already running at a pretty healthy pace that would prevent inflation from getting back down to 2%, which is the Fed's target. So you throw all that together, and you get the rise in the term premium in the 10-year yield. So it's gone from negative about 50 basis points to positive about 10 basis points. And that's really accounted for most of the increase in long-term yields.
Which means then that it's not simply that the market is suddenly panicked about inflation going forward, because that component of yields maybe is not the principal driver. Does that mean that bonds are a pretty good deal at these levels? In other words, you're getting compensated for buying them here with yields roughly where they are?
Well, I would say inflation expectations are a component of it. But I think when you look at the bond market, what looks attractive is, like, say, tips. So real yields are 2.25% to 2.5%. So, if you are a buy and hold investor looking to lock in positive real yields, these are the highest real yields we've seen in about 15 years. So in that way, tips look pretty attractive. In terms of where we would invest in the Treasury market or investment grade corporate bonds, we like kind of keeping duration on average or a little bit below benchmark, because we see some room for yields to move up some more. But I do think that if you're an investor looking for income, you can get 4 to 5%, maybe higher in income locked in over the next 5 to 10 years. It's not a bad proposition for a balanced portfolio. So there are opportunities. We just want to be a little bit cautious because we see room for yields to move up a little bit more from here.
And Jeremiah, I guess the big question among equity investors coming into this year is, do you bet on the clear winners of 2024, and we still have this mega cap driven market with the dominant growth stocks leading, or are there other maybe more neglected themes that you would emphasize now?
Yeah, so I think it's a mix of both. So I think the secular growth drivers that have been driving earnings growth and market gains over the last 2 years, I think they're still in strong footing and will continue to drive those earnings gains. But we have seen, different volatility within sectors and within different parts of the market based on whether they were viewed as favorable as a result of the new administration or not. And so there are some opportunities in the market that have retraced in Q4 that we think are positive opportunities, but we also continue to believe in the secular themes of AI and software. But there are other themes like capital markets and travel that we think will continue to provide attractive opportunities as well.
Yeah, we just showed on the screen, I think Royal Caribbean, Goldman Sachs, both have been big winners last year.
Yeah, so we think the outlook for capital markets is positive. We're well under normal levels of equity IPOs as well as M&A. Goldman Sachs is obviously extremely well positioned in that recovery. They also have a strong asset and wealth management business, and it's still only trading at 13 times 25. So we're excited there. We also think travel data continues to be very positive. In Q4, we heard a lot of positive data points from the credit card companies, from airlines about consumers continue to spend on travel. We think the outlook for discretionary spending next year is still positive. And Royal Caribbean and the cruise line industry in general, we think is well positioned. They've done a great job differentiating their products, appealing to more demographics. And Royal Caribbean's only at 16 times. They've restarted the dividend and are returning capital back to shareholders. And so that's another name that we think is attractive for 2025.